Hello, everybody. After a lull in the IPO market, the September month is going to see a flurry of IPO offering. And Happiest Minds Technologies IPO happens to be the first among that. And in this presentation, we will look at this IPO a little bit detailed. First, a few facts about the IPO. This is an IPO which will be opening on 7th of September and goes on till 9th of September. This is a 100% book built IPO. They are offering close to around 4.2 crore equity shares of face value to amount aggregating to 702 crore. Fresh issue consists of 110 crore and offer for sale is 592 crore. And IPO price range is 165 to 166 per share, and the market lot is 90 share. Minimum order quantity is 90 share. And post IPO, it is going to get listed in both BSE as well as NSE. Out of the information shared, the most significant one is the issue size as well as the split between fresh issue and offer for sale. And let's try to understand how it is significant and what is the difference between a fresh issue and offer for sale. For that, let's look at the capital structure of a company in detail. It all starts with an authorized capital. Authorized capital is the maximum capital that a company can raise, and this is the capital with which a company is registered with. An authorized capital, it consists of issued capital as well as unissued capital. Issued capital is that part of the capital which has been given to the shareholders and subscribed by them. To understand that perspective, let's consider a company which is registered with an authorized capital of 10 crore. And during the initial phase of its operation, the company might not require the entire 10 crore to start off the business. It would be able to start off the business with, let's say, 4 crore rupees. And the promoters have contributed this 4 crore. So as far as that company is concerned, the issued capital for the company is 4 crore, and the remaining 6 crore is the unissued part of the capital. Okay, coming to offer for sale. In offer for sale, those shares which is held by the promoters, that is offered to the public, and the funds the public is giving when they subscribe to the shares, that will be given to the promoters. The company is not going to get any money out of this proceeds, and that's where unissued capital and the fresh issue matters. Because fresh issue, it happens from the unissued part of the authorized capital, and those shares are offered to the public, and the funds which is offered by the public, it straight away go to the company. As far as this Happiest Minds IPO is concerned, the share of offer for sale happened to be 592 crore, and the fresh issue happened to be at 110 crore. And it is this 110 crore which matters to a potential future investor, because it is this money the company is going to reinvest in its business, which can result in better future cash flows for the company, which can improve the future cash flows in the company, and then consequently it will get reflected in the future share prices. Yeah, so having understood that, now let's look at how this particular IPO offering is going to change the shareholding pattern. As far as the promoter is concerned, the promoter is having 61.77% of the company's shares before the IPO, and post issue, this proportion is going to change to 53.25%. And if you look at the purpose of this particular IPO, as stated by the company is going to spend the entire 110 crore to meet the long-term working capital requirement of the company as well as general corporate purpose. So here, one thing that you have to notice is the company is going to depend upon a long-term source of capital like equity to finance its working capital. And how prudent is that strategy? To understand that, let's look at the business model of the company a little bit detail. Happiest Minds, it's essentially a software company. And as you know, as far as a software company is concerned, it's maximum expenses would be on human resources. And the same thing is quite reflective there as far as the financial statements of this company is concerned. So here you can see that this is the profit and loss account statement of Happiest Minds. You can see that the employee benefit expenses, it is amounting to 44,123. These figures are in lakhs, and out of the total expenses of 62,760, 44,123 is in employee benefit expenses. And that being the case, it is important for a company like Happiest Minds to always stay liquid. Liquidity management is very important for this company, because if the company has got enough liquidity, then they will always have money to pay off salaries even at a difficult business situations. So let's look at the liquidity management of this company. The company has got cash and cash equivalent to the tune of 43,000 I'm sorry, 4,350, and other current assets like mutual fund investments and deposits with the bank to the tune of 28,574, and its overall expenses, okay, those expenses which are current in nature, it is amounting to 60,737. And yeah, these are also figures from the P&L. You can just see here the total expense of the company is at 62,760, and I am taking off depreciation and amortization from that one, which is of non-cash expenses. So those expenses which the company has actually need to spend and which is essential for running the company is, I am taking it at 60,737. And to understand the current assets position, okay, we can look at the balance sheet. You can see that the total current asset is at 44,511, but I am not considering trade receivables as well as loans. Loans, primarily the company has given some loans to the subsidiaries as well as employees. Why I'm not considering that one is it will always take time for the company to receive the trade receivables. I'm considering only those assets, those current assets which are quick assets. All right, so those cash in hand, okay, the cash positions of the company as well as the investments. And when you look at these investments, okay, the financial investments, it is primarily mutual fund investments as well as deposits with the bank. The details of which you can get it from the notes to the accounts. Okay, so we'll just have a look at it, quick look at it. Yeah, you can see that all these deposits, and as well as the company has these mutual fund investments also. So anytime company can realize these investment and use it for its working capital requirement to paying off salaries. So that way, if you see this figure, if you consider the company's annual expense is at 60,737, divided by 12, you will get a monthly expense which is around 5,000 rupees, and liquid assets the company is having to the tune of 32,000, which essentially says that the company has got adequate resources to run the business for 6 months without any interruptions. This is without considering the trade receivables and uh, the loan, potential loan repayment which can happen on the loans which is given by the company. So that is a very good liquidity management arrangement the company has. And another noticeable feature about the company's financial statement is, we will go back to the company's profit and loss account once again. Okay, you can see that when it comes to the finance cost, okay, in the year 2019 it was at 1589, and the company has almost halved, okay, it to 799. So which again made me to look at Okay, this is basically the interest expense the company has. This made me to look at the cash flow statements of the company. And if you look at the cash flow statement of the company, you can say that cash flow from financing activities. There are a lot of debts the company has repaid. So all these negative figures that you see, barring that particular repayment of the lease liabilities, okay, all of them are loan repayment which the company has done. So this has taken the company's leverage position at a very, very attractive level. So let's look at that gearing ratio of this particular company. Again, let's go to the notes to the accounts. Yep, you can see that compared to 2018, the gearing ratio has improved from a 32 percentage to 12 percentage level. If you look at a gearing ratio, so you can just see that the company has significantly reduced its gearing ratio in 2020 level. So which essentially means that the company's finance cost is going to be very less. So that will have a positive impact on the part of earnings which can be earmarked for the equity capital contributors. So that will result as better earnings for equity contributors, and it can potentially get reflected in the share price of the company. So that way, company is managing its liquidity as well as debt position and the books on a very robust manner. That's a very good indication. And next, if we look at the valuation of these companies, the company's diluted EPS is at earnings per share is at 5.49 and the base EPS is at 7.21. The company has issued some preference shares, some 14% preference share. So that part of the profit which need to be earmarked for or adjusted for the preference share capital, the diluted EPS is at 5.49. And considering the offer price at 166, we are getting a P ratio of 30 times. And if we calculate P ratio based on the base EPS, it is at 23 times. And this is a very comparable figure to the industry. You look at Infosys P ratio, it is at 23 times with a PEG ratio of 2.54. And Mindtree, which is at 26 times with a PEG ratio of 6.28. L&T Infotech, which is at 27 times with a PEG ratio of 1.87. And I have not considered the PEG ratio for Happiest Minds because a software company which is in the initial phase of its operation, it will have more of expenses. It will be very difficult for the company to show a profit because they have to spend some time on developing a product and fine-tuning its product offering. They have to acquire clients and then start offering the services to the clients, the product and services to the clients. So it will always take time for a software company to kind of reach that kind of a level. But considering that, or the pace at which Happiest Minds have scaled up its operation, it is quite commendable. You can just see that the company started making profit from last year itself, and before that, the company was showing losses in its books. And then you can see that the earnings per share, it has been improved from 0.33 to 5.49, and which if you consider as an improvement of less something like 1500% improvement, and if you calculate the PEG ratio based on that, okay, yeah, you know, in when you calculate PEG ratio, you will discount the P ratio with the earnings growth. That is again coming to something like 1.52% kind of level, again very much comparable to the industry thing. So considering that, this offer at 166 looks very attractive, and we have also seen the potential of the company considering the reduction in the interest burden, which is reflecting in the company's financials. And how sustainable is this particular growth? For that, we need to understand, or we need to look at the company's business model and what the company is offering. So the company's earnings uh, and segment, you can divide it into three categories. One is revenue from infrastructure management and security services, and revenue from digital business solutions, and revenue from product engineering services. And you can just see that a good chunk of the business is coming from the digital space. And when I say digital space, the technological focus this company is having is on big data, cloud computing, data science, IoT, which is offered as solutions in the form of mobile analytics platform, digital assisted selling platform. And you look at all the product offerings, you can see that this is a space that every software company is aspiring to occupy. You know that the traditional Indian software companies, they are all that legacy sweatshops wherein they bill human resources. So that's the way that's what the business model for the Indian software companies. So every big names in the industry, they are kind of trying to climb up that particular value chain and trying to reach the the kind of business model that Happiest Mind is having. So you have a company which is right from the inception itself has set standard for the industry and uh, offering business solutions which other software companies are aspiring for. That could be the reason why they have come out with the tagline "Born Digital and Born Agile." And another remarkable thing about this particular company is like they have built this competency across industries. You look at the product offering, they have got product offering across industries, ranging from automotive to banking to e-commerce to education publishing, travel and hospitality, retail, manufacturing. So that way, the industry coverage, it is quite diverse. Okay, so that itself is a risk mitigation as far as this particular product offering is concerned. And then the company already has a customer base of 168 customer, which is spread across geographies, starting with India, Europe, Asia, and North America. They have got some very significant dollar revenue as well. This is a point that we will be coming back a little bit later. And Yeah, the next important thing about this company is the man behind the company. It is Mr. Ashok Soota. It is a well-known name in the Indian software industry. He was the founder for Mindtree. We have seen how Mindtree has been transformed and later resulting in its transfer. And then Mr. Soota was also behind Wipro during the late 80s and early 90s. He was instrumental in scaling up Wipro's operation and made Wipro what it is today. So it is the very same person who has started up Happiest Minds Technologies as well. So the kind of management competencies that this company is boasting of, that is something the future investors can completely rely on. And some potential red flags about this particular company. Uh, One is the general market sentiments. We know the kind of market environment in which we are operating. The markets are extremely volatile, and these potential bad sentiments in the market, if it is bringing down the share prices, that can potentially affect the company's future share prices as well. And the next thing is the challenges that every company is facing because of the pandemic. If that act as a hindrance for this company to bring in new order inflows, that could be a potential red flag as well. And the next thing is, I've already told that the company has got some significant uh, revenue proportion from the in the form of dollars, and dollar is in a downward spiral. So that weakening of dollar can be another potential threat to the company's future earnings potential. Uh, and altogether, considering the valuations and the kind of business that this particular company is in, This is an offer which can generate a great investor uh, interest once this particular issue opens up uh, for the public to subscribe. And some important dates uh, for this particular IPOs. As I said earlier, the IPO is opening on September 7th and it will go on till September 9th. So typically you will get 3 days for investing in this particular IPO. The basis of allotment, it will be finalized by 14th September, and then the potential date for refund is September 15th, and you can expect credit in your demat account by September 15th if your bids were successful. And another potential date for listing this particular IPO is September 17th. So I hope uh, you have you would have liked this particular presentation, and if that's the case, please consider subscribing this particular channel. We would be coming out with a lot of analysis on upcoming IPOs. You can also give us suggestions, the IPOs which you want us to cover, and we would also be coming out with a lot of investment ideas in the future. To get an update about all that one, subscribe to this particular channel, and like this video and share us. That would be appreciated. Thank you everybody, and all of you have great times ahead.